So welcome everyone, and thank you for joining us for a special edition of our Upside Avenue educational webinar series. This series is developed with your input. We surveyed our investors and followers to find out what financial investment topics matter to you the most. And then we find subject matter experts all over the country to speak on those topics. This is in hopes of providing you with the knowledge and confidence to discover your upside. So watch your email and information for our next webinar, and we'll share it on our social media channels as well. So today we have not one, but two speakers lined up. Not only that, they're both named Tom, and they're here to talk to us about diversifying your retirement account with REITs. Tom Schmidt is the Business Development Officer of Mainstar Trust. Tom has over 30 years of financial experience, and he leads the business development for Mainstar Trust, which is a self-directed retirement custodian. Mainstar Trust assists investors in utilizing their IRA, 401ks, HSAs to invest in various types of alternative investment products, including notes, LLCs, private stocks, non-traded REITs, and many others. When he's not working, Tom enjoys spending time with his family and especially going to the lake house. It sounds great, especially now in the summer and during pandemic times. But before we hear from Tom Schmidt, we also have Tom Parker here with us. He is the Director of Investor Relations here at Upside Avenue, and he's responsible for managing investor and wealth advisor relationships. He specializes in providing educational insights on the multifamily real estate market and the benefits of real estate investment trusts. Tom is passionate about food, fitness, hiking, fishing, hunting, sports, live music, and spending time with friends. So, without further ado, I'll turn the time over to you, Tom Parker.
Thank you, Jess, for that introduction. Once again, my name is Tom Parker. I'm the Director of Investor Relations here at the Upside Avenue REIT. Today, in my portion of the presentation, I'm going to be talking about why you should consider investing in real estate. I'll be talking a little bit more about multifamily, how it's classified, and some of the projections we have for the greater multifamily markets. And then I'll be defining real estate investment trusts and telling you a bit more about those. So without further ado, I think we can jump right into it. With our first slide here, why should you consider real estate? First of all, real estate is a tangible asset. It's something that can be touched or felt. Because of that, it gives you, the investor owner, a lot of control. So you can go in and improve that asset to enhance the performance. Real estate is also going to be non-correlated with the stock market. So even in times of economic downturn or stock market woe, you can still see returns from a real estate asset that you own or are invested in. Real estate assets in a perfect world also provide you with dividends and appreciation. Oftentimes dividends come in the form of income. So throughout ownership, as long as you have tenants paying a lease, you can make income. And then the old adage in real estate obviously is buy low and sell high. So if you buy an asset at the right price, improve it, hold it, and then sell it, you hope to sell it at a higher price than you bought it, and the gains seen from that are going to be your appreciation on that asset. So talking about modern portfolio theory basically stipulates that in an investment portfolio, you want to diversify as much as possible so as to create the highest return while also having the lowest level of risk. What this chart shows is in that top line, in a portfolio where they've allocated 20% of that portfolio into real estate and compared to just 20% into normal stocks and bonds, you're going to see a higher risk-adjusted return in that portfolio that's invested into the real estate space. So there's many types of real estate, office, industrial, retail, residential, or multifamily, just to name a few. But here at Upside Avenue, our specialty is investing in multifamily apartments. We do look at student housing and senior living, but those are more niche of the multifamily space. And so I'll be speaking predominantly to multifamily today. So why should you, the investor, consider multifamily? In the residential space, there are a lot of investors who prefer to do kind of single family dwellings. The risks of that is if you have a single tenant dwelling and that tenant then vacates, you're not going to be able to see income from that property until you get a new tenant to sign a lease. Also, if that property is owned and managed by you, it's a big time commitment to go in and make sure all the improvements are done to the property. And this can also cost you more money to put into the property as well. Multifamily apartments, because you're dealing with multiple units, you can have a tenant vacate, but you're still able to receive income from that property because you have the other 99 tenants who are still paying rent. Real estate or multifamily also takes advantage of the economies of scale. And generally, apartments are going to be managed by professional management teams. They are asset managers who manage the investment logistics, and they can maintain that the property is performing to what it was underwritten to. Multifamily as a market is also seeing a very high demand trend. In a forward look done by the National Multifamily Housing Council, it's projected that another 350,000 new units are needed by 2030 to meet the demand in multifamily. This is above the prior 4-year deliveries of 244,000 units per year. So where is this demand coming from? Renter population growing is largely attributable to millennials through 2041. Generally, it's projected that they are not ready for home ownership, so they are preferring the rental space. But they are not the only cohort of the population that is increasing the demand. In the 2015 census report, it was projected that 5 million baby boomers are actually going to be renting their next home by 2020. And that's because baby boomers actually want the same upscale, amenity-rich multifamily rentals in urban neighborhoods that promise the flexibility, cultural vibrancy, and newfound sense of community that you find in apartment homes. So I think it's important when looking at the lens of multifamily to understand how we're defining each asset. Every asset is basically classified, and this is based on its condition, age, or an area that it's in. So Class A is going to be your newest class of apartment. These were the most recently built, and they're in the most desirable locations. They're going to feature the highest rent, and they're going to be the most expensive to rent out of. The next class you're looking at is going to be, or the next two classes are going to be Class B and C apartments. These were built anywhere from the early 80s all the way to the early 2000s. They generally have room for improvement, are popular in the value-add multifamily space. They're in decent areas, not the most or least desirable, and they feature a diversified tenant base, often featuring anyone from white-collar workers all the way through blue-collar workers. The last class is going to be D-class apartments. These are the oldest and most run down. They are generally in the least desirable areas that have high crime and low income. So why is it important to understand asset class? In an op-ed done in the Multifamily Executive magazine, done by our CEO, Yen Young, in an article entitled Asset Class Selection for Portfolio Balance, he speaks to the importance of understanding asset classes. Generally, renters are going to be priced out of Class A apartments in times of volatility or recession, and this causes vacancies to increase in that space. For example, the national vacancy rate in the first quarter of 2017 increased 10 basis points to 4.3%. This takes into account all asset classes. In this same time frame in the affordable multifamily space, vacancies were only 1.7%. Also, Class A properties are generally expensive to build and feature a high property tax tag. And because of that, it makes the upfront investment quite significant. Class A construction was also at a 7-year peak, according to the Wall Street Journal, and the sudden oversupply of luxury apartments has made Class A less profitable across the board. Meanwhile, you could acquire a B or C class complex for cheaper, still have that lift in net operating income through improvements, and still have a very successful investment. Multifamily rental sector itself outperformed other sectors of the housing market during the downturn of 2007. In fact, by 2013, multifamily housing starts had already returned to more than 70% of their pre-recession peak. Single family had only returned a small portion of their recession low. So throughout 2016, we also saw that multifamily kept above average performance, disproving the prediction of higher occupancies. And also, despite moderation in rent growth, it remained above the historical average. There's even brighter predictions for the future, but we're still obviously the most prevailing concern right now is coronavirus and living through these times. So I think it's going to be important to speak to that as well. We at Upside Avenue do not like to do too much speculating, but what we can do is discuss what our strategy is and what our tactics are throughout the coronavirus period. Obviously, as I said earlier, the old adage goes, buy low, sell high. So we are still looking for low basis investments, and we're still, providing safety in our underwriting with the exterior concerns of the effects that coronavirus has on the market. That said, the tactics do have to change. So value add traditionally is going to be more difficult to do in times of downturn. Rents are going to be lower. Generally, the wage income has dropped. So where we may be purchasing a C or B minus asset, we're probably going to adjust actually up a class, look for more well-located, good quality assets, something in A minus, B plus, B space. That way there's not as much improvement necessary. We can keep occupancies high and thereby keep taking income out of these properties even in times of downturn. Now, as coronavirus continues to exist in society, obviously there could be room for distressing markets. So we will continue to look for deals that we feel have a very good price point and still have, a great space for improvement. So now I'm going to be talking about kind of changing gears here a little bit. I'm going to speak a little bit about how a REIT actually works. So in a REIT, you're buying shares in a portfolio of properties. Why this is important is apartments generally cost a lot of money. So even to passively invest in an individual deal, you generally have to be an accredited investor. As an individual, that would mean that you have to have a household income of $200,000 or more a year. As a couple, you would still have to have a joint income of $300,000 a year, or your total individual or combined net worth has to be greater than $1 million. REITs do not have this requirement. For a much lower bar to entry, you're able to invest in the same properties that highest net worth individuals or corporations are investing in, and you'll still see the benefit that those properties can provide. REITs, as I said, are also a portfolio of properties, and through that diversification, it can provide you protection to your investment. So if one property in the portfolio isn't performing well, you still have the rest of the properties in that portfolio that can then allow the investors to still see good income as well as appreciation throughout the whole period. Also, in a REIT, going back to the time and money management portion, in a REIT, you're not responsible for managing an asset or investing more into that asset to improve it. So you get the benefit of dividends and appreciation, protection from the downside risk, and you're not having to spend time actually managing the asset and making sure it's performing the metrics you underwrote it. So I think it's important to define the different types of REITs. We have publicly traded REITs. These are generally the same as any other stock you could buy on the major market. Because of that, they are susceptible to the volatility in the market. If the overall market goes down, then your REIT stock on a public REIT stock is going to go down similarly. They are registered with the SEC and traded on the market. Public non-traded REITs are registered with the SEC, but they are not traded on the market. This provides you some protection in the event of market downturn, because that share pricing is going to be directly correlated to the underlying assets in the portfolio. So as long as the REIT has assets in the portfolio and those are performing, you, the investor, will still see returns completely insulated from whatever you've invested in the public The last type of REIT are private REITs. They're not registered with the SEC. They're not traded on the market. Actually, a lot of times they're only available to institutional investors. So it doesn't really speak to the lower bar entry that I was talking about earlier. So with that, I've actually come to kind of the end of my portion of the presentation. I would like to hand it off to Tom Schmidt, who, as Jeff said, is the Business Development Officer at Mainstar Trust. He's going to be talking a little bit about setting up an IRA, answering some common questions that clients often have when setting up an IRA, and then speaking about how you can use your IRA to invest in real estate, and more specifically, upside avenue.
Sounds good. Thanks, Tom. And Jessica. All right. So I think we're ready now. Can everybody see that okay? Okay, super. Well, again, Tom and Jessica, really appreciate it. We'll talk a little bit about three things here. One, just a little bit about Mainstar, so you know who we are and kind of what our role is. We'll talk a little bit about IRAs and the opportunities with an IRA. And then we'll talk a little bit about the investment process in the Upside Avenue products. So we'll start with Mainstar. We've been in business for 40 years, and we're known for our exceptional personalized customer service. That's one of the ways we differentiate ourselves. We publish client reviews on our website, so you're welcome to take a look at those. And we're very proud of our experienced, knowledgeable team. Our senior leadership team averages more than 20 years, not only in financial services, but specifically working with IRAs. And if you're familiar with IRAs, you know, they're a great thing, but they're also complex, or can be complex. And so having a team that can help you along the way is very important. As Jessica said in her introduction of me, you know, we really focus on the self-directed IRA industry.
Sorry, we're having a little bit of audio problems. Do you have anything covering your speaker or microphone by chance?
No, is that any better?
Yeah, that's better.
Okay. Yeah, thank you. Let me know if you have other issues hearing me. But yeah, so we focus on self-directed IRAs, and our specific focus is on the non-traded investments, typically. So a non-traded REIT, much as Tom Parker mentioned, is something that many of our clients invest in. We are one of the largest custodians nationally. We custody about $8.5 billion in assets. We're headquartered in the Kansas City metropolitan area, but we have clients in all 50 states. Our fees are very competitive. One of the things as you look at custodians, some custodians will charge fees based upon the size of your account. We don't think that's the appropriate approach. So our fees are all flat service-based fees. So as you make more in your IRA, the only fees you're going to pay us are based upon the activities that you request of Mainstar. So from there, just a little bit more about us as an alternative investment custodian. There are a wide variety of investments that can be held in an IRA. Non-traded REITs, as we talked, hedge funds, private placements, raw real estate meaning direct real estate, limited partnerships. I'm not going to cover those today, but it just emphasizes the opportunity of using a self-directed IRA for many types of investments. So talk a little bit about your responsibilities as an investor in a self-directed IRA. You're responsible for the due diligence and suitability. You're ultimately responsible for the investment decision. We always recommend that you consult with either your tax or your financial advisor or your legal professional on what's right for you based upon your age and your risk tolerance, etc. Our responsibility as a custodian is, you know, the IRS has dictated that to have an IRA, there must be a third party that takes custody of the assets within the IRA. So that is our role. We do the record keeping for you, and that includes the tax reporting both to the IRS as well as to you. But we're a service provider, so we really do not provide any type of investment advice. We look at the underlying investments, but in a different type of way. We really don't do due diligence in terms of feasibility for you as an investor. We look at it more from an IRA standpoint. Certain types of investment, like collectibles and certain types of products are not allowable in an IRA. So we do a review, but at the end of the day, it's really important that you do the full due diligence on the investment product with your financial professional. So I want to cover just for a minute some of the common questions we get. I'm asked frequently, hey, I have a 401k, can I self-direct it? Unfortunately, the answer typically to that is no. There are exceptions to that. Some plans do allow for that. That would be something to ask your employer or your former employer or their plan administrator. And I'll come back and talk about rollover opportunities if you've terminated employment from that employment, because that does open things up, if you will. Good news is, though, you can self-direct an IRA. That's what we're here talking about. You can also self-direct an individual 401k. If you're not familiar with an individual 401k, it's for a small business owner that is self-employed. It may be the person and their spouse, but they can't have any W-2 employees to have a self-directed IRA. I'll cover some of the other benefits later, but the IRA and the self-directed IRA come into play quite frequently. And for many investors, they have a fairly significant portion of their assets actually in retirement accounts. So to amplify on that a little bit more on a rollover, you may have heard that term. You can do a rollover into an IRA or the individual 401k. Again, it's typically coming from a defined contribution plan like a 401k, employer plan, or it could be coming from a defined benefit plan, which would be like a 457, 403b. The other thing you can do, though, if you have an existing IRA, just be aware that there's a lot of flexibility that the IRA provides you with. So some investors, let's say they have an IRA that they have as a brokerage account, right, with the brokerage firm. You can actually take a portion of that money from the brokerage account and set up, say, a separate self-directed IRA with Mainstar Trust, and then invest in the Upside Avenue product as an example. So the IRA gives you all kinds of flexibility. You can split them, you can consolidate them, and you can move them from one custodian to the other. Going back to your former employer, rollovers from an employer or from a plan have specific eligibility requirements. And typically the requirements would be either you've terminated employment, you've retired, or you meet the eligibility requirements of the particular plan. And some examples of that would be, you're 59 and a half, or in some plans it may be age 55, etc. So in that particular situation, you'd want to consult with a third-party administrator from your 401k plan just to make sure you're eligible. But typically, if you've terminated employment or you're retired, you're over 59 and a half, it would definitely be the case. But there may be some other unique circumstances to your plan that you would want to look into with the third-party administrator. So there's a variety of self-directed accounts. I'm not going to go into all of those today. I'm going to highlight some of those that are most common. An example, health savings accounts. You can self-direct a health savings account. More and more investors are accumulating wealth and using the health savings account almost as a long-term savings vehicle. So that's another example. Let's drill down on the most common types. So I'm going to talk first about the types that as an individual you would most typically contribute to. The first is a traditional IRA. It is pre-tax, so you are eligible for a deduction according to the IRS depending on your income limit. And there's a whole table of income based upon your income. It determines whether you can contribute, and if so, how much. If you're able to contribute, you're able to contribute up to $6,000 a year. There's something called a $1,000 catch-up provision for those who are over age 50. You'll notice the Roth IRA is very similar in that way. The difference, though, a Roth IRA is post-tax, so there's no deduction on your return with a Roth IRA. there are, again, income limits in terms of whether you can participate or not. So we always recommend you talk with a tax professional about what makes most sense for you. The investment growth is very important. In a traditional IRA, it's tax deferred. In a Roth, it's tax free for the life of the Roth. On the traditional IRA, at the point that you take money out of the IRA, not of the investment, but out of the IRA, a traditional IRA is taxed at ordinary income rates. There is also something called a required minimum distribution that happens beginning at age 72. It's based upon the life expectancy of the investor. So that's something to definitely be aware of from a tax planning standpoint. The Roth IRA, one of the benefits there, though, is if you have a Roth IRA and you've held the Roth IRA for 5 years after contribution, and assuming you're 59 and a half, it grows tax-free for your lifetime, and there's no RMD. And you can pass it on to your heirs without any inheritance tax. So there's pros and cons to each one based upon your circumstance. The other thing I want to highlight is the tax impact of selling an investment product within your IRA, because this one is sometimes confusing for people that we talk with. So as you say, invest in the Upside Avenue product, and at some point when you liquidate that product, some point in the distant future, and then let's say you decide you want to invest in another Upside Avenue product, so that your liquidation, if you will, from that first product would go back into cash into your IRA, and then you could use that same cash to invest in the second product, as an example. The point I'm wanting to emphasize here is it's not a taxable distribution. So moving money from the investment back into cash into your IRA and then back into another investment is not taxable. So that's a real benefit for investors. I want to highlight very quickly the small business accounts, and primarily because they have some significant advantages if you're a small business owner. The first is a SEP. And you can see the contribution can be up to $57,000 a year. It's based upon income as well, or 25% of the employee compensation, but your employer has to have a SEP plan, and you individually cannot contribute. The employer has to make the contribution. So a lot of times you'll see SEP plans set up by the small business owner, if you will, but that's a plan for a business that has employees. Contrast that, though, with, and I should say the SEP plan is pre-tax. It works very similarly to a traditional IRA, rather, in terms of the tax-deferred investment growth and distributions and whatnot. The individual 401k that I talked about a little bit earlier, depending on how it's set up, can be pre or post-tax, so that's nice. And again, it's for the individual that doesn't have W-2 employees unless it's a spouse. But you can see there's substantial ways to contribute to that individual 401k by doing so. So you can contribute $57,000, an additional $6,000 if you're over age 50. So to summarize, I get the question quite a bit, how do I get a lot of money into my IRA if it's not already there? And the most common way is from a rollover from, say, a 401k or a retirement plan, if you're eligible. And then the second way would be by contribution, either to an IRA or to a SEP or an individual 401k, depending on your situation and depending on whether you qualify. So those are just things to think about and be mindful of as you're thinking about investing. So let's talk about how you invest with Upside Avenue through your IRA. So it's a pretty straightforward process. The thing I'll tell you, though, is we do not expect for you to be an IRA expert. That's our job. And so as you have questions going through the process, we work with you to answer those questions because everyone's circumstance is a little bit different. So You go to our website under forms. We have kits set up based upon the type of IRA that you're setting up, whether it's a Roth or traditional or say an individual 401k. You would select that kit. And then there are 3 forms that you would complete and send back to us. So that's the first step, and they would be sent to customer service at mainstartrust.com. The second step, it would be if you have a rollover from your retirement plan, a 401k that you're eligible for, or you're consolidating your IRA, or you just would like to do a contribution. There is a form on the first 2 that's called the transfer rollover form that's within that kit. You would complete that, and that form provides Mainstar with authorization to move the money, say, from your 401k to a Mainstar IRA. If, on the other hand, you want to do a contribution, there's just a form to do that contribution as well. The third step in the process is there's a form called the Mainstar Purchase Authorization form, and you complete that form to authorize Mainstar to invest your IRA in the Upside Avenue Multi-Housing Income REIT. And so those are the 3 Mainstar forms. The 4th form that you complete is the Upside Avenue Fund Subscription Document. And so the 3 Mainstar forms and the Upside Avenue Subscription Document would all be sent back to Mainstar Trust once you're completed. And as I mentioned, as you go through the process, definitely reach out. We have specialists that can assist you with any questions along the way, whether it's the overall process or whether it's specifically on the forms. Again, don't be afraid to reach out. IRAs are a great thing, but sometimes they can be a little complex, and based upon your individual circumstances, they can vary from one person to the next. We do have, I'd encourage you, we have an ebook that we put together on self-directed IRAs on our website. I provided the URL. I'd encourage you to go to our site, download the information. It just goes into a lot more detail about the various types of IRAs that I've covered today, and it's a great resource guide. So take a look at that. Talk about the fees. These are the Mainstar fees for using your IRA. So it's $110 a year as an example for if you have like a traditional IRA. It's a $24 cost to invest in the Upside Avenue Fund. So your ongoing cost would be $134 a year. And then there are one-time transaction fees, $25 to set up the account, and then $25 at the time you purchase the fund and $25 at the time you sell it. But the ongoing cost would be $134 a year. There are slightly different costs depending on the account type. So if you were doing an individual 401k, it would be a little bit different. Be happy to cover that individually with you, but our complete setup fees are at mainstartrust.com. But I just wanted to give you a feel for the magnitude of investing with an IRA. It's $134 a year, so pretty straightforward. And again, we're always here to help, whether it's today or subsequently. You can reach out to us, set up a consultation. Joe Cordell and Joe Barnes are always very helpful going through forms and answering any of those questions. So with that, I'm going to turn it back for general Q&A with Jessica and Tom.
Perfect. Thank you so much, Tom and Tom. All right. I'll give you a moment to our listeners to go ahead and ask your questions just by entering them into the Q&A box down below. And while we're waiting, I do have a question. I was talking to friends of ours who, they're not U.S. citizens, but they are living here and working here legally. Are they able to open IRA accounts?
Yes, so that would be, depends on their specific circumstance, but generally speaking, you would have to be a U.S. citizen, and you would be filing a U.S. tax return. So that'd be a good question based upon their circumstances to talk with a tax professional about.
Okay.
But typically it's a U.S. citizen because like if you're contributing, let's say, to a traditional IRA or even a 401k, you're looking for the tax benefits, if you will. So yeah, it's a tax deferred instrument, if you will.
Thank you. I'll let them know. All right, let's see if anyone else has some questions here. All right.
I was going to clarify too, just to Tom's point, if you are interested in using your IRA with to invest in Upside Avenue, we always are open to walk you through that investment process as well. I know from the IRA perspective, has a wealth of knowledge as far as being able to set up the accounts and getting funds in there. But I know sometimes even with our REIT, it can be tricky to get through our investment modal. And if you ever have any questions, you can always feel free to reach out to us directly, and we'd be happy to get you walked through that.
Perfect. We do have a question here. Can commercial or income property be sold and transferred to a REIT as like-kind property?
So I think what they're referring to is a 1031 exchange into a REIT. I couldn't really speak to that. From what I understand, generally with a 1031 exchange, is you have to basically take the proceeds from the sale of one property and then go and invest them into a like property. That said, my knowledge of exchanges is relatively minimal. So you may want to do some more research on that one. But from what I'm familiar with, you couldn't 1031 proceeds from the sale of a multifamily apartment complex into a REIT.
Thanks for that question. We have another one here. Do you get quarterly payments from the multifamily trust?
Yes. So the Upside Avenue REIT has dividends that are released every quarter. So that is the income portion. Also, when you invest in our REIT, you're buying shares. At the end of each year, we go and reevaluate the portfolio. As the portfolio increases in value, your share pricing will increase in value. So you'll get income every quarter through dividends. And then upon selling your shares, as long as the portfolio is appreciated in price, you'll see some gains as well, selling your shares at a higher price than you bought them.
Great questions. Anyone else? Do REITs provide K-1 forms? Are REIT distributions or dividends inside a Roth IRA tax-free? So I guess let's tackle the first one. Do REITs provide K-1 forms?
I can't speak to other REITs. I just know with Upside Avenue, the only tax form we have associated with it is the 1099 on ordinary income.
Okay, and then are REIT distributions or dividends inside a Roth IRA tax-free?
Absolutely, they are. And so the key there is what I mentioned, that 5 years after the contribution, the first contribution in the Roth IRA, the earnings for the life of the Roth IRA are tax-free for the life of the individual. And now that's assuming you're age 59 and a half. But as long as you're 59 and a half, yeah, that's one of the real benefits of the Roth IRA. The other thing that I should have mentioned for everybody too, not to go into too much detail today, but there is something called a Roth conversion from a planning standpoint, tax planning standpoint. And so many investors evaluate that with their tax professional. And that's a way to take money that's in a traditional IRA, move it to a Roth IRA. There are tax implications. You pay the tax at the time you do the conversion. But for investors that believe they're investing in a vehicle that's going to have really substantial long-term growth, from a tax planning standpoint, they may want to, have their money in a Roth over the long run versus a traditional. But that, again, that comes down to individual circumstances. It's just something that you should be aware of and talk with your tax professional about as well.
Another great question here. Is there a 401k that is also a Roth?
Yes, there can be. So it really depends on the way the plan itself is set up. Frequently today on the 401k side, the participants within the plan will be given that option, but it really depends on each and every plan. So that would be something to talk with your employer or their administrator about. If you're setting up an individual 401k, say with Mainstar, that would be a decision point. Am I setting it up as an individual or on a pre-tax or post-tax basis? a lot of times what happens is if they're doing a rollover from a 401k, they'll end up moving it over in the same manner as the original, say, 401k. So the 401k being pre-tax typically would come over, say, as a traditional. If it were set up as a Roth originally, then it would come over typically as a Roth.
Great questions, everyone. All right. Any more questions before we wrap things up for today? Let's see, we have 401k SE. Can those be rolled over to the Roth type?
I'm not sure on what's being referred to on the SE.
Could you clarify that? Self-employed.
Yes. So if it is an individual 401k and it's an individual 401k that's a Roth, then it could be rolled over to a Roth IRA. If it's an individual 401k that's traditional, it would be rolled over to a traditional IRA. And then if you wanted to move it to a Roth, you would do a conversion from the traditional IRA to the Roth IRA. Little complicated there. Be happy to discuss it in more detail based upon the circumstances, but it sounds like it'd be a possibility.
Perfect. Oh, he says, thank you. Another question. Is there any minimum or maximum amount you can do until, oh, the question got cut off. Is there any minimum or maximum amount you can do?
I was going to say, from Upside Avenue's perspective, is there a minimum amount for investment?
Yes. So our minimum investment threshold is $2,000. That said, with an IRA consideration, I do always say just doing the $2,000 minimum. If you start to factor in, say, 5% income a year, there is still flat fees you would be paying for your IRA. So you may consider doing more than just the minimum, but yes, to get into the REIT would be a $2,000 investment.
And I'll answer it from Mainstar's perspective. We follow the investment guidelines of the investment product. So as a custodian per se, we don't have a minimum, but if you were investing in the Upside Avenue product, you would need to meet their requirements that are part of their subscription agreement. So from the IRA standpoint, there's no minimum. Now the contribution guidelines come into play that I covered earlier, so you can't contribute more than the IRS allows, that type of thing. But once that you have the money in the IRA, it's really subject to the vehicle that you're investing in.
Great questions, everyone. Anyone else have questions? We've got a few more. Does Upside have access to private REITs?
So we are a public non-traded REIT. So I'm not really sure. No, I wouldn't say so. We just are a public non-traded REIT. I know that kind of sounds like a straightforward answer, but we as a company are managed by the Custodian Group, which is a private equity multifamily investment company. And the only REIT we have under our hood is Upside Avenue, which is public non-traded.
Any other questions? Makes sense to me. All right. Great questions, guys. Keep it coming. We got a few more minutes before we need to wrap up for the day. All right. Well, thank you so much to, what kind of returns in the REITs? Oh, great question.
Yes. So Upside Avenue, as I said, because we're investing in multifamily, you will see dividends through appreciation each quarter. We're projecting those to be anywhere from 5 to 8% annually. Generally recommend, similar to when we invest in a property, holding that investment for a minimum of 3 years. That said, you could sell your shares after the first year. But throughout the hold period, as the share pricing appreciates and the property appreciates, we're projecting another 6 to 8% in appreciation by the end of hold period. So in total, it's between a 12 and 18 or 16% return over annualized over a 3 to 5 year period.
And Tom, the dividends are eligible to come back into the IRA in cash. Is that correct?
Correct. So we also have a distribution reinvestment plan, so that would allow you to take your dividend and automatically reinvest them. But if you were to not do the DRIP and you were invested with an IRA, then yes, that dividend would be going back to your IRA.
And I was just going to highlight, if you decided not to take advantage of the DRIP, the thing as self-directed IRA investors, keep in mind is that cash is going to be in your IRA. It's not taxable, but then the next step would be, okay, how do you want to invest that cash? So that's something to think about if you were to decide not to participate in the DRIP program.
And how long has Upside been doing this?
So we actually launched, so the REIT became a REIT in, it was January 2017. We first dispersed funds out of escrow in November of 2018. So the REIT has been around for almost 2 years. That said, the REIT management company, the Casoro Group, has been investing in multifamily deals for 17 years, or actually over 17 years now.
These are fantastic questions, you guys. All right. Well, Tom Schmidt and Tom Parker, thank you for sharing your knowledge and helping our listeners learn more about diversifying their retirement account with REITs. Oh, wait, we do have one more question. If I start investing at age 55 and 59 and a half, will I be able to withdraw my money out of the Roth IRA tax-free?
Yeah, so if I understand the question correctly, if you started investing at 55 and you take it out after 59 and a half, it depends on whether you have a traditional IRA or a Roth. If it was a traditional, when you would take it out after age 59 and a half, you'd be taking it out at ordinary income rates. On the other hand, if it's a Roth, you would have to hold it for 5 years after that initial contribution. And as long as you're 59 and a half and the 5-year parameter had been met, then yes, it would be tax-free coming out of a Roth.
So in this particular instance, he's saying if he invested into a Roth at 55, 59 and a half wouldn't be quite that 5 years. Is that correct?
That's right.
Okay. Great. All right. Well, thank you again, gentlemen. There's a reason why real estate is America's favorite way to build long-term wealth. And it's great that we have low barriers of entry into that asset class with REITs like Upside Avenue, and that we can get tax benefits from it by using our IRAs. If any of you have questions, further questions for either Tom Parker or Tom Schmidt, we have their contact information here on the screen. And thank you to our listeners for joining us. Let us know if this content is helpful to you. There's a survey that will come up after we end today's session. And let us know if there's other financial or investment topics you're interested in learning about, and we'll go and find subject matter experts to speak on those topics. Because at Upside Avenue, we're committed to helping you discover your upside. So because this is a bonus webinar, we actually have our regularly scheduled webinar coming up in just 2 weeks. So please watch your email for the registration for that one. It'll be on estate planning tips. And you can also follow us on our social media accounts for the latest industry news and insights. You can discover your upside with Upside Avenue. Through our multifamily REIT, you can enjoy the benefits of real estate investing for as little as $2,000. You can visit our website, upsideavenue.com, for more information, or you can email us or call us with any questions. Thank you for joining us. Stay safe, everyone, and see you soon.